The South Korean currency has been losing substantial ground against the US dollar, reportedly ranking as one of Asia's worst performing currencies this year. With more on Press Perspective today. Hello and welcome to Wednesday's edition of Press Perspective for December 24th here in Seoul. I'm Min Sunhee. Efforts are in the works to stabilize the South Korean currency as it surrenders much ground to the US dollar. For more on this, I have Steven Borowiec with Japanese weekly news magazine Nikkei Asia here in the studio. Steven, welcome.
Nice to be here, thanks.
I also have Professor Oh Joon-seok at Sookmyung Women's University joining our session virtually. Professor Oh, as always, it's a pleasure.
Merry Christmas, Sunny.
Right. We shall start here in the studio. Steven, let's begin with some information about the South Korean currency's loss of ground against the US dollar, especially in recent times. How severe is the won's latest decline, Steven?
I'm not an expert here, so I don't feel like I can give a definitive statement as to how severe it is. I think we'll get into that more as our conversation goes along. But I can just cite some assessments from recently released figures from Morgan Stanley, who said that the won was the weakest performing Asian currency over the course of this year, and it lost 7.75% against the US dollar. And that this has become an area of major concern for policymakers and for, I think, just people in the country as a whole. Over the years, over the decades, we've constantly heard this chattering about how the won is a kind of undervalued currency that outside investors kind of fail to appreciate the vibrancy and the reliability of South Korean companies. So this has been going on for some time, but one thing I've noticed in recent months, throughout this particular slide by the won, is that maybe there is more to it than this. Maybe this is a kind of a permanent restructuring. Maybe the won will not quite be able to bounce back in the way that it did in the past. So we'll get into that more as our conversation goes along, but I would just point out that in recent months, South Korean officials have done what they customarily do, where they make statements. Just today, the finance ministry quoted some officials as saying that they would, they're very much on top of this, they're monitoring it, and they plan to show a firm resolve to address this. Those kinds of moves have not really been having the desired effect. The won has continued to lose ground to the dollar. So I would just, before we get into anything else, I would just point to what I see as kind of a few factors behind that. And I think what it kind of boils down to is that more and more investors are frustrated with the relatively weak returns that they're seeing on investments here. This is a pretty, especially compared to the US, is a low interest rate environment, and there's a kind of growing consensus particularly among young Koreans, I think, that customarily where a lot of Koreans put their money is in real estate, and housing prices are still going up, as we know. But if you're young, if you don't have a lot of capital, if you haven't inherited a lot of money from your parents, that's a really hard market to break into, especially in the kind of more desirable neighborhoods of Seoul, where prices are growing much faster than anywhere else. So you see people increasingly taking their money to the US, increasingly looking at kind of more higher risk but potentially higher reward investments like cryptocurrency. And so, like I said, I guess I'd like to hear more from Professor Oh. He knows more about this than me. Is this a cyclical thing, or is this something kind of grimmer than that, a sign of a reorientation of the Korean economy? Time will tell.
Right. That being said then, Professor Oh, what more can you tell us about the reasons behind the South Korean currency's relentless retreat? Many are saying it's a combination of external and internal factors. Mm-hmm. What are your thoughts?
Yes, right. It's a combined factor, as Sunny mentioned. Korean won is approaching its lowest level since 2009. And yes, definitely domestic factors are more of a problem, so-called causa proxima, the nearer of other factors. The won has fallen more of 6% over the over the past 3 months, the largest decline among Asian currencies, and then which is driven by two major factors. One is continuous foreign stock outflows, and the other one is increased overseas investment by residents. Foreign investors have sold 5.2 billion US dollar in local stock market this month. The strong dollar regime in 2025, backed by a robust US growth and rate differentials, has increased the downward pressure on Korean won. Korean companies that retained earnings abroad, keeping profits overseas rather than repatriate to Korea, rose by 7.8 billion US dollar, a 40.2% increase from that of last year. Korea faces susceptibility to external changes, particularly in global trade and capital movement, as its currency markets are often affected by U.S. Treasury yield and the appeal of capital. External tensions such as tariff and trade policy uncertainty from the U.S. raise risk premium on Korean assets and currency. So the won is often labeled one of the weakest global currencies, given how export dependency magnifies vulnerability. Korea is an export-driven economy, definitely. When the export engine suffers, the currency often bears the brunt. When the capital outflows more than inflows, economy engine loses heat. By combining these two factors, domestic demand in Korea has been gradually weak. Consecutively, retail sales, building activities, and even consumer spending have fallen behind, hindering growth potential. So the Korean economy in 2025 can be summarized by weak demand internally and slowing export and headwind externally.
Right, and hence our lower currency value for now. Stephen, as you mentioned earlier, the government has been actively seeking to stabilize the South Korean currency. What have been some of the measures that have been taken?
There were what we mentioned before, we call so-called verbal interventions, and I think this is an important part of managing markets. Is just the question of messaging, of just getting in front of audiences and quoting officials as saying that this is what they intend to do, that they are not asleep at the wheel, that they're taking this seriously. And just today, after these finance ministry remarks came up, the won ticked up somewhat, but. In terms of that, I think policymakers are, just due to the changing nature of the economy, they're somewhat limited in what they can do. I mean, I think one thing that they did was they extended a currency swap with the National Pension Service that was worth something like 65 billion won. And I believe, I would speculate that government officials are speaking behind the scenes with their sources in the major economies, the major companies, your Samsungs, your Hyundais, your big Korean firms that operate a lot overseas, and trying to convince them to convert more of their earnings back here in South Korea and to have that money circulating in the economy here. But beyond that, I read one column today that what the government really ought to do, that's all short-term stuff. So in terms of seeking a more long-term solution to this, what is at roots of this is the perception of South Korea as not as promising of an investment destination. And to address that, really, you need to have growth, you need to have productivity, you need to invest in things that are going to achieve a more kind of sustainable economic uptick. So I think that really what the government ought to be doing is investing in technology and investing in new growth engines, and hoping that by seeking to improve the fundamentals of the economy, it can have the kind of trickle-up effect of boosting the currency and boosting the kind of overall impression of the South Korean economy.
Right. What about you then, Professor? What do you believe could be some of the measures to counter this relentless drop of the South Korean currency? And what are your thoughts with regard to the government's countermeasures?
Whether the measure will be effective or not should be checked from the view of direction of the price movement, speed and stability of fluctuations. The trend and movement of a currency price might be analyzed from the side of the trade movement or side of capital movement. I comment about causa proxima of the situation now comes mainly from outbound capital movement. The won lose half of its value during the 1997 crisis. price, and then came under renewed selling pressure during the global financial crisis of 2008. Since then, Korean authorities have been very wary of the extreme currency swings. When it comes to the direction of the movement, multiple government measures are likely to be ineffective. Korea's demand for the US dollar has been growing sharply across the board and pushing the value of the one currency to its lowest level since 1998. This trend will likely continue, and in a worst-case scenario, exchange rate could fall past over 1,500 won per dollar in the upcoming days. But regarding a series of monetary measures taken by BOK to modulate the speed of fluctuation and stabilize the foreign exchange market, then the policy direction is right at large on the right track in increasing the dollar supply. Though the impact might be expected to be gradual as time goes. The measures include the emergency meeting with major export-oriented conglomerates suggesting for a foreign currency profit repatriation into Korea, and a foreign exchange swap agreement between the BOK and NPS, and the temporary suspension of a stress test that had pressed financial institutions regarding their dollar holdings. It might be effective, I thought so.
Right, and while efforts are in the works to stabilize the South Korean currency, consumers of imported food products here in the country, Steven, are feeling the pinch. What have been the broader implications of a weaker won for consumers here, as well as for businesses that export or import products?
Before getting to the broader implications, I would just say that this is an issue that's close to home for me, as a person who lives in Korea and who enjoys imported food. While I know this is very much a first world problem, but watching the prices of my beloved cheeses and wines and things like that go up. But there's a few things we could say there. I mean, like the basic, the economics 101 of this is that if your currency becomes weaker, you need more of that currency to buy to something that's denominated in a foreign currency. So that comes with imported goods. And so just the basic reality is that if you live in South Korea and you are earning South Korean won, it becomes more expensive to buy things from abroad. This is happening at a time when I think that South Korean demand for imported goods among consumers is much higher than it used to be. I definitely feel like if you go shopping in Korea, the imported goods, imported food, or cosmetics, or toiletries, or clothing, or all these kinds of things are much more widely available than they used to be. And I think that the tastes of South Korean consumers have changed. So definitely in the short term, I think that it's likely to see some price increases there. We are at a time when overall inflation has moderated. It's much lower than it was during the pandemic and immediately following the pandemic. I think it's like pretty much in the Bank of Korea's desired range. But Sunhee, to get to the point of where also talking about trade, which goes in both directions. South Korea is a export-led economy, so the conventional wisdom there has long been that having a weak currency can kind of be a blessing in disguise for a country that is exporting things because it can make your exports cheaper. We definitely saw this after the 1997-1998 financial crisis, where the Korean currency really tanked, and then what got the economy humming again was a mostly unexpected boom in exports, which took place in the subsequent months and years and led to a faster recovery than anybody really expected. That, I think, will have a more modest effect nowadays than it did decades ago, because nowadays more and more South Korean manufacturers have their bases of productions overseas, either in Southeast Asia or the US or wherever it happens to be. So they're not benefiting from the weaker currency to quite the extent that they might have in the past. But we'll have to wait and see. I mean, again, going back to my own selfish interest in this issue, I hope that the Korean currency spikes so that we can all enjoy, especially around the holidays, the delicious imported goods on offer at a more affordable price. But again, just getting back to what we said earlier, I think the real issue here is can the government invest and orient its policy in a way that can get growth going more sustainably again, and that would have a lot of positive effects in these kind of more micro indicators that we see.
Right, for sure. In the meantime, staying with trade, Professor, exports during the first 20 days of December soared 6.8% on year to post a new high for the period with a total of $43 billion. What are your thoughts regarding this performance, Professor? And is it sustainable, do you think, in the new year?
I hope so, but it's not likely that. As Steve commented about the international trade environment, considering the fact that Korea is an export-led economy, a lower currency can have benefits in export side, especially major two items of export now, chips and cars. They will get a price edge definitely. So companies such as Samsung Electronics have been reporting record profit for years, thanks in part to strong earnings in the U.S. and a favorable exchange rates. Korean car export to the United States also rise in November, ending 8 months of slump caught up in the struggle against the so-called reciprocal tariff shocks. But a weak won also causes a price of import to rise, with Korean importing most of its energies and raw materials. The BOK has warned already a persistently weak won could pump up cost-push inflation above its target. This might be interpreted as a sustainability of this performance becomes weaker in 2026. The KDI forecasts that export volume growth will slow significantly to 1.3% in 2026, down from 4.1% in 2025. Despite the export slowdown, the general economic outlook is a recovery, projecting GDP growth of around 1.8% to 2.1% in 2026. Now go over to the measure to be taken afterward. I would agree export of AI chips and other high-tech products are expected to remain a strong driver in our economy despite prolonged geopolitical tension and uncertainty of the global economy. But to boost up the domestic demand, it might be expected for the BOK to take active monetary easing rather than fiscal policy, which is most appropriate for Korea now.
Right, monetary easing then for Korea. And speaking of 2026, Stephen, what more can you tell us about the outlook for South Korea's economy?
I think most assessments are that the economy will fare better next year than it did this year. One thing I think we haven't mentioned yet is that in 2025, South Korea went through a lot of political uncertainty. We had a constitutional crisis early in the year and a very high-profile trial and constitutional court decision, and then an election in June. Things have been pretty smooth since then. As somebody who reports news for a living, I can tell you I haven't been filing political stories nearly as often to my bosses in the second half of this year as I did in the first half. But the economic effect of that is that it had a very downstream effect on consumption. It just really sapped consumer confidence and just a lot of people were not really in the mood to go out and spend when, on the streets of major cities, people were protesting, and there was this sense of a larger kind of national crisis. I think that made a lot of people feel as though it was not really appropriate to go out and engage in displays of consumption. People didn't really want to party. People maybe didn't want to have as many events that they were buying new clothes for and things like that. That will not be the case in 2026. We hope that we'll have a calmer year, and as of now, I think the predictions are coming on the assumption that there will be a political stability going ahead, and that will have a positive effect on consumption and resilience. Resilience has been displayed by the experts, as Professor Oh outlined, despite some kind of downward predictions due to global trade tensions and things of that nature. Shipments of those key items, the kind of high value items like autos and semiconductors and batteries and things like that have been pretty strong. So I believe that international bodies such as the International Monetary Fund and the World Bank and all the rest are forecasting headier times for South Korea than we saw this year. But these underlying issues such as the weak currency still are a matter on policymakers' minds, and we'll all be hoping for a fruitful and prosperous year, I think.
Right, and as we hope for a better year in 2026, Professor Oh, what are the key variables that South Korea needs to perhaps keep its eyes on to ensure economic expansion next year?
Also, Steve mentioned before, to ensure economic expansion in 2026, Korea must focus on boosting domestic demand more than anything else. And it is very, very appropriate time for Korean economy to make a structural reform to strengthen its tech sector like AI, semiconductors, to advance the economic quality and then sustainability. In this respect, urgently needed is revitalizing consumer spending through accommodative monetary policy, and the real wage growth is desperately needed. Including political and structural uncertainties, one needs to keep its eye on would be interest rate decision of the BOK. In addition, the movement of difference in interest rate between the U.S. and Korea can attract capital or discourage it into the capital market of Korea. Economic experts anticipate that the BOK will relax its policy next year with a 25 basis point rate reduction expected in response to slow growth in inflation. Lower rates help stimulate domestic activity, but they also risk capital outflows in the capital market. It is very, very sensitive. So lower rates help stimulate domestic activity, but they also risk of weakening currency due to rapid inflation in an economy.
All right, that would require quite a bit of balancing act by policymakers then. All right, Professor, I'm afraid that's all the time we have today. Thank you so much for your time and your thoughts, Professor, and also Merry Christmas, Professor.
Thank you for having me.
Right, and here in the studio, Steven, Merry Christmas. Thank you.
Merry Christmas to you. Thanks.
Right, on that note, we end this edition of Press Perspective. Thank you for watching. See you same time on Friday, as tomorrow we rest in celebration of Christmas Day.